Okay, folks. Your quizzes are now inside my office since you refused to pick them up in a timely way. So if you want them, you have to come and get them from my office. If you don't want them, I don't care. Right? So I'm still working on your DCFs. I think I've about 92 left this morning. I was checking, so I'll get to that 92 sometime soon. By Friday, you should have them. Yeah. But you should be getting them now as I stagger them out. So today we're going to switch gears. And I said the email I sent yesterday, I talked about the mindset difference between doing intrinsic valuation and pricing. And you're going to notice that today as I talk about pricing, how my emphasis shifts on what I look at. So today's start of the class test, we're going to start with questions about pricing. So things we kind of ignore. Let's start with the first of these questions. Okay? A lot of people out there, equity research analysts, bankers, prefer to use multiples, PE ratio, EV to EBITDA, EV to sales. If you ask them why, their defense is, I don't like to make assumptions about cash flows, growth, and risk. And you have to make a lot of those assumptions in a discounted cash flow valuation. Is that true? Absolutely, right? You've all done DCFs. Think of all the assumptions you layered on top of each other. So analysts say, I don't like to make those assumptions. I'm going to use a PE ratio. So here's my question. When you use a PE ratio for a company or an EV to invested capital or an EV to sales, are you making assumptions about cash flows, growth, and risk?
Yes, you are. Assuming at least the growth and risk are comparable to the other.
If I use the average, so now let's say you pay 100 times earnings for NVIDIA, which is what you're paying right now. Are you making assumptions about future growth in NVIDIA? Yeah, you're implicitly assuming the growth will be. Here's the difference between discounted cash flow valuation and pricing. In discounted cash flow valuation, your assumptions are explicit. In pricing, they're implicit. You see why the danger with pricing is because they're implicit. You don't even know what you're assuming when you pay 100 times earnings. So one of the things I'm going to do with each multiple is I'm going to talk about what are the cash flow, growth, and risk assumptions embedded when you pay 5 times book value or 100 times earnings or 20 times revenues, because you need to be aware of what you're assuming when you buy something. Let's keep going on this. One of the mindset shifts I think I mentioned when I talked about going from intrinsic valuation to pricing is an intrinsic valuation, it's finance that drives it. First principles of finance, discounted cash flow models. In pricing, it's data and statistics. Some of you might not like that shift because your statistics might be a little shaky, but you have no way around it. So I'm going to ask you a question that's a statistical question. Let's assume I compute the PE ratios for every company in the market. It's not difficult to do. I can do it. And I put up a distribution of those PE ratios. Remember the one distribution you still remember from your statistics class? The normal distribution, right? Can PE ratios be normally distributed? Anybody want to give that a shot? Sebastian, what do you think? The PE ratios be normally distributed. What do you think? What's the essence of a normal distribution? You remember the tails stick out on both sides, right? Where do they go from? Minus infinity to plus infinity. P ratios can never be less than 0. When earnings per share become negative, price earnings ratios become not meaningful, not available. So the lowest value of PE ratio can take is 0. What's the highest value of PE ratio can have? Be any number. It can. So if you think in terms of statistics, this is called a right skewed or a positively skewed distribution. You say, who the heck cares? And I remember in my statistics class thinking, why would anybody care? Right skewed, left skewed. This sounds like something inside statistics. We're going to talk about why that might matter in investing, that PE ratios have this right skew to their distribution. And finally, I'm going to play the role of a very naive equity research analyst. I'm going to come to you with a recommendation, and I want you to push back. So here's my recommendation. I found the stock that trades at 12 times earnings. It's a software company. The average PE for the software sector is 20. So I tell you the company is cheap. It might be, but I'm going to give you 3 questions you can ask me that will tell me whether the stock is really cheap or whether it deserves to be cheap. Ready? Somebody give me the first question. What's the first question you're going to ask about this company to decide if it's really cheap or just looking cheap? Yes.
How much is it growing?
First is you're going to ask what's the growth rate. Most of the time when you have a company trading at low multiple of earnings, what kind of growth rate are you going to see in that company? A really low growth rate, right? So what's your growth rate? What's the second question? Go back to intrinsic. Yeah. How risky is it, right? So maybe I got the high earnings per share by ending up borrowing too much money. Riskier stocks should trade at lower PE ratios. And there's a third question. Is all growth made equal? What is what? The earnings are in the denominator, but from that earnings, I need to collect cash flow. So what separates it? How much I'm reinvesting to get the growth, right? You're going to ask me, what's my return on equity? Most of the time, when you see a stock trading at low PE ratio, it's either because earnings growth is negative or very low, it's because it's risky as a company, or because it has very low return on equity. The essence of pricing is you're looking for mismatches. You know what I mean by mismatch? You want a stock that trades at a low PE ratio, but has high growth, low risk, and a high return on equity. You're saying, what chance do I have of finding something like that? No harm looking. There are 48,000 publicly traded stocks. You might find that, that nugget that nobody else has found. So with pricing, it's all about trusting the data and letting the market determine where you're going. So with that, I'm going to go back to the valuation, the first packet, and complete that discussion because there are a few loose ends we didn't get to. First, remember we talked about financial service companies and the contortions we go through to value financial service companies. Very different beast. I want to talk a little bit about companies with intangible assets. So give me examples of companies which might have a lot of intangible assets. What sectors are you going to see them in? Yeah. Pharmaceuticals, and the big intangible asset is the patents you have in drugs. So if you look at Novo Nordisk and you look at their physical assets, you're not going to see the biggest source of value, which is the R&D they did 7, 8, 9 years ago that gave rise to Ozempic and Wegovy, which is driving the value of the company, right? What else? So pharmaceutical companies. Entertainment companies, again, because your biggest assets, if you look at Disney, came from creating a Mickey Mouse character. Some of their assets might be physical. So you got entertainment, you got pharmaceuticals. Technology companies, right? You look at the Apples, the Amazons of the world, your biggest. You're saying, what's the big deal? From an intrinsic value standpoint, there is no big deal. I could ask the questions and get the same answers, but here's the problem. The accounting is screwed up. Is screwed up in what sense? Now, typically, if a company invests in assets that create value for the long term, they're capital expenditures, right? A manufacturing company, it's shown as CapEx. But we talked about how accountants screw up R&D. or R&D like expenses. And let's face it, that is the common feature across these companies with intangible assets, is the expenses they incur to create those assets are not shown as assets, which means everything gets thrown off, your earnings, your book value, your return on capital, which means when I ask this question about cash flows, growth, and risk, you're going to be stumbling because the accounting doesn't help you. So you know already what you need to do, right? This is actually, it's probably late to be doing this. Now I'm going to try to explain why we did what we did earlier in the class when we converted R&D expenses from operating to capital expenses, recruiting expenses. It's not because we're nitpickers. We're the exact opposite. It's because without doing it, you cannot really value an entertainment company, a software company, a technology company. You have to make those changes. So when I capitalize R&D, I know this is a throwback to the first quiz. I'm going to ask you some questions about what it's going to change. First, does it change earnings when I capitalize R&D? What is the effect on earnings? It depends, but what is the actual adjustment? I add back the R&D expense and I subtract out the amortization of, so my net income changes, my operating income changes. What changes in my balance sheet when I capitalize these expenses? I have an asset and my book value of equity goes up, right? So if I were to trace out the effects, and this is a case with Amgen, here's what the numbers look like before I make the R&D adjustment and after. And there's a huge shift in my numbers. My operating income jumps by about 2.3 billion. My return on capital increases. In this case, you can see how the numbers shift. In the case of Amgen, when I capitalized R&D and I valued the company, I got a value that was almost $32 higher than what I got when I did not capitalize R&D. You know how you can test this out? I know many of you, when you did your DCFs for your companies, are capitalizing R&D. There's a yes, no on that. Just take the yes and change it to no. Look at what happens to your value per share. In some of your companies, the value will go up. In some of your companies, your value won't change much. In some of your companies, your value will go down when you capitalize R&D. I have a question though. It's an intuitive question. And somebody out there is going to ask you this question. They're going to see the mechanics of your value going up and they'll ask you, why is my value going up for some companies when I capitalize R&D? And for some companies, the value goes down when I capitalize R&D. What is it about Amgen that you're learning when you capitalize R&D and you see the value jump? You want to try? That's a very surface level. So my R&D increasing will affect my earnings and affect my invested capital, right? But why do we do R&D? Because we want to increase earnings. You know, the kinds of companies where R&D capitalization is going to increase value is companies that do R&D efficiently. What does that mean? They do R&D and they have higher earnings to report. Amgen, that was the case when I valued Amgen. This was in 2012. I also valued Merck in 2012. I capitalized R&D. There, the value per share dropped by 25% when I capitalized R&D because Merck was very inefficient about the way it was spending its R&D, spending billions of dollars and had nothing to show for it. It goes back to why we capitalize R&D. We capitalize R&D because we want to treat it the same way we would investing in a factory. When you invest in a factory, it creates growth, right? But before I give you credit, I look at what you've invested, the return on capital you make on that investment, and compare to the cost of capital. And if the return on capital is less than the cost of capital, you're growing, but you're destroying value. We're doing exactly the same thing when we capitalize these expenses. So this is a reverse rationalization of why we spend so much time on that issues with these kinds of companies if you don't do that. Sure. I sent you my Birkenstock IPO in one of the valuations of the week. I know you didn't even look at it. I'm a realist on these things, but go back and look at it. Because in Birkenstock, you had intangibles coming out of every orifice of the company. I'll give you some examples. This was a company that's 250 years old, but 10 years ago, it got a new management team to come in from the outside. It'd been a family-controlled company. They got an outside manager to come in who happened to be a really good management. Is really good management an intangible? Absolutely. So that's the first issue. The second is Birkenstock has a brand name that other companies would kill for. It's a brand name they got entirely by accident. Birkenstock didn't plan hippies wearing Birkenstock in the 1970s, but hippies liked Birkenstock because they wanted to rebel against the culture. They didn't plan college students taking up Birkenstock because, they saw somebody wearing Birkenstock. This is a company that's accumulated a brand name. So it had great management, a brand name. And it was lucky for me because I did this in September at the time of their IPO. And I talked a little bit about this early in the class. There was the Barbie buzz. What's a Barbie buzz? In the movie, Barbie wears pink Birkenstock. It caused a 30% jump in sales over the summer. So if you take a look at the Birkenstock valuation, I valued Birkenstock as a company, and then I did something I usually don't do. I decided to break out each intangible and talk about how much of the value came from that intangible. So great management, I think, is the reason Birkenstock went from single-digit growth to double-digit growth in the last decade. They found new ways to grow. The brand name shows up as higher margin, pricing power. We'll talk a little bit more about this later in the class. I gave them a higher margin. And the Barbie buzz showed as a one-time jump in sales because that's going to fade. About 2/3 of Birkenstock's value comes from intangible assets. As an investor, I really don't care. That's why I said as investors, you don't make a big deal about this. But to value these companies, you have to bring in those intangibles where in your growth, your margins, your reinvestment, or your cost of capital, there's no place to hide. Ultimately, it's got to show up in the numbers. So I want to pause. Any questions about intangibles? Think about any intangible about a company, throw it out. It's a challenge. Let's think about where to show it in evaluation. Let's talk about valuing cyclical. You had an intangible? No. Let's talk about valuing cyclical and commodity companies. What do they share in common? They're very much at the mercy of macro forces. What does that mean? You could be a mature automobile company, but whether you sell a lot of cars or not very many cars depends on the state of the economy. Cyclical companies, as the economy strengthens and weakens, their numbers are going to move around. With a commodity company, it gets even worse, right? Let's take the example of an oil company. Today, if you look at the revenues, the earnings, the cash flows for oil companies, they look pretty good across the board. Why? Because oil prices are $86 a barrel. 2 years ago or 3 years ago in 2020, remember oil prices went to 32. Every one of these companies looked like a basket case. Put simply, if I think about the value of a company coming from the cash flows, the growth, the risk, and will you be a mature company? Every one of those questions, the answer is going to be a function of are oil prices high or oil prices low? Is the economy doing strongly or badly? So the risk of stating the obvious with these companies, it's very easy to get lost in the macro component. So when you're valuing an oil company, what are you going to be tempted to do? Forecast out oil prices, right? Because it is true, as oil prices change, the value of your company will. When you're valuing a cyclical company, you're going to be tempted to forecast out when will the next recession be, how strongly will we recover? And my advice to you is don't. Don't forecast oil prices. It sounds like a strange thing to say, but let me explain why. Let's assume that you've done a deep dive into oil prices, and you've concluded that based on demand and supply, oil prices will double over the next 5 years to $200 a barrel. You decide to value Royal Dutch, building in that assumption about oil prices, that oil prices will double. What do you think you'll find as a value for Royal Dutch? That it's undervalued or overvalued? What do you think your end conclusion is going to be? It's going to look undervalued, right? You're going to ask me to buy. And then I'm going to ask you a question. Do you want me to buy Royal Dutch because you like the company or because you think oil price will double over the next 5 years? You think, why does that matter? It matters a great deal. Because if it's the latter, there's a much easier way for me to make money, right? What can I do if I think oil price will double over the next 5 years? Buy oil or oil, but where would I store the oil, right? So don't buy oil and put it in your backyard. Whole neighborhood might go up in flames, but you'd buy oil futures or oil options. If you're that good at forecasting commodity prices, stop valuing commodity companies. You're going to get rich without even trying. If you mix up your macro views with your micro views, I don't even know whether to act on your valuation because I don't know whether it's because you think oil prices will double or because you like Royal Dutch as a company. So I'm going to make a suggestion that's actually very difficult to adhere to. When you value commodity companies or cyclical companies, try to be commodity price neutral with the former and economy neutral with the latter. Don't bring in your points of views on those into your valuation, because then you mess up the end result. The second is, even after you're done, even if you're valuing an ExxonMobil, mature oil company, at the end of the process, you're going to be really uncertain about one variable. You know what that one variable is going to be? If you're valuing an oil company, what's the one number that keeps you up at night when you invest in these companies? What will happen to the price of oil, right? And I know you're all struggling with uncertainties with your DCF valuation. Daisy came into the bank and said, I don't feel sure. And I said, you will never feel sure. Why? Because the future is always uncertain. So I'm going to give you a technique for dealing with your uncertainty, not making it go away. That uncertainty is a feature, not a bug in investing. It's called a Monte Carlo simulation. You've never heard of it. Let's step back. The valuations you've done are point estimate valuations. You know what I mean by that? When I asked you for a revenue growth rate, you had to give me a number, right? What did you use, Daisy, for your revenue growth rate? Do you remember? Just make up a number. Nobody can check. 17%, okay? But as you gave that number, your insides were screaming, but I am uncertain. I could be wrong. I could be wrong. And for each of you on those inputs, revenue growth, margin, sales to capital, your reaction was, I've given a number, but I don't think I'm right. What if I allowed you to tell me how uncertain you were about the revenue growth rate? You know what I mean by that? In addition to giving me the 17%, you said, you know what? It could be anywhere from 10 to 25. And this is what the distribution of growth looks like. And the same thing with margins. So rather than hide from uncertainty, what if you faced up to it and you gave me distributions for growth and margins and sales to capital? You say, what am I going to do with those? In a Monte Carlo simulation, here's what I do. I go in and pluck out one, so go to distribution of growth, pick a number. Go to the margin, pick a number. Reinvestment, pick a number, and I value the company. And then I do it over and over again. Hundreds of times, thousands of times. Each time I do it, I get a different value. You're going to give me thousands of values. Yes, but I'll give it to you in the form of a distribution for value. So I'll give you an example. You heard of Royal Dutch, right? One of the oldest oil companies in the world. It's British or Dutch, depending on the day you look at it. It's kind of this, netherworld company. It's a mature oil company. And this was a valuation I did of Royal Dutch in 2016 when oil prices hit a low at $45 a barrel. So I value the company. And remember what I suggested you, be price neutral. I value the company using, $40 oil price. The value that I got was $39.31. So I basically projected out revenues and earnings, not assuming oil price will rise, but they would stay at $40 and go up at whatever the forward market is, which is going to be roughly equal to the inflation rate. So it's an oil price neutral valuation of Royal Dutch. The value per share I got was $39. And I presented this to the Royal Dutch Finance Group in Houston. And of course, these people are immersed in oil and oil prices. And they said, this is so unfair. And I said, what's unfair about it? He said, well, oil prices have dropped from 60 to 45. They'll go back up. And if they go back up, what will happen to the value? And the answer is obvious. If the oil prices go up, what will happen to the Royal Dutch value? It'll go up. And if the oil prices go down, I said, that's what's going to happen. He said, so how do you bring in that uncertainty? I said, there's a way to do it. First, let's look at how as oil prices changed, Royal Dutch's revenues have changed over time. I went back all the way to 1989. See the column, that's my revenues. The brown line is the average oil price each year. Let me ask you an absurd question. Do the two look like they move together? It's really, right? If you don't believe me, let me bring out the statistical big guns to back it up. I computed an R squared. And every dollar increase in the oil price increases my revenues by $4 billion. Let's face it, if you're investing in Royal Dutch, you don't care who the CEO of Royal Dutch is and what the management looks like. This is about as pure a play on oil as you can get. But this regression, basically, of past revenues against oil prices is going to become useful in my Monte Carlo simulation. What's the variable I'm most uncertain about? The oil price. So here's what I did. I brought in the oil price into a distribution. I'm going to close up that. I brought the oil price as a distribution. So help me out here. How would I come up with this distribution of oil prices? Oil is a traded asset, right? I don't want to make up stuff. So I went back and looked at 25 years of oil price. I looked at the percentage change. I put in a distribution. The distribution was centered around $45. Why? Because that's where the oil price is today. But basically, the distribution says oil prices could go up to $80, $90, $100, or they can drop to $15, $20, $25. Remember how I said the distribution works, or the Monte Carlo simulation works. I go pick an oil price out of the distribution. It could be $70, right? If I pick a $70 oil price and I feed it in, I get much higher revenues. So I estimate the revenues based on the regression you saw on the previous page. I plug in a $70 price. I get high revenues. That traces to, I get a value per share. Then I go back and do this again. I was actually taught how to do simulations in 1979. The way my instructor taught it was he brought in glass jars with pieces of paper with numbers written on them. You pick one out of the first. If you did this with the glass jars and piece of paper, this is going to take you the rest of your lifetime to do. But I don't know whether you know this, but at NYU, you have access to a program called Crystal Ball. Crystal Ball is an add-on to Excel. What it allows you to do is take your existing discounted cash flow valuation. If you add Crystal Ball, instead of entering a number for revenue growth in my spreadsheet, you can actually enter a distribution. And here's the magic. At the end of the process, you don't get a single value for your company, you get a distribution of values. Remember, why do we do valuation? To decide whether to buy a stock or not, right? Earlier, I gave you a value per share of 39 for the company. The stock was actually trading at about 41, and I told you the stock is pretty close to fairly value. But all you have are two numbers, the price and the value. Here, instead of giving you one number, I'm going to give you the distribution across the simulation. If you had to pick one number from the simulation, which is out of the distribution, which is going to be the number that so if I let you pick only one number out, probably pick the median value around $37, right? But if I asked you at $41, what is the likelihood that my stock is undervalued? Could you answer that question here? You'd basically go through, it's about 60 to 61%. There's a 61% chance your stock is overvalued, 39% chance it's undervalued. You see how much richer your decision process is now? In addition to giving me a value for the company, you can say there's a 67% chance my stock is undervalued. You will never get 100%. So don't go looking for that. There's no slam dunks in equity. But as a decision maker, it's a much richer way of making decisions. When I valued NVIDIA in February, I came up with, you remember, value 440, the stock was trading at 800. And I knew I would be asked the question, could NVIDIA be worth $800 per share? So I ran a simulation. You know what the answer to the question is? Could NVIDIA be worth $800 a share? Yes. There's a 13% chance it's worth more than 800. There's an 87% chance it's worth less than 800. I'm not going with those odds. I don't like those odds, but maybe you do. It's a great way to not make this about your value or my value. This is a question of where are the odds in your favor, and this gives you a way of quantifying those odds. This is not required for this class. You don't have to do it, but Crystal Ball is free while you're a student. It is $800 once you graduate, right? So download it if you can, steal it, hide it. I don't think they allow you to do it, but if you can find a way to do it subversively, do it. It's a great add-on to any kind of job you have in business, because uncertainty is the name of the game. This gives you a way of quantifying and facing up to uncertainty. There are two things that you need to run simulations on. One is, if the only distribution you remember from your statistics class is the normal distribution, please don't do simulations. Because everything then is normally distributed. It's garbage in, garbage out. It's great looking garbage, but it's garbage in, garbage out. So first, you got to invest some time and resources going back to statistics. You say, I don't want to do that. I'll save you some trouble. I have a 12-page, I won't even call it a paper. It's really a practitioner guide to how to pick distributions. Right tail, left tail. Because I think Crystal Ball gives you 53 different distributions. And most of them you're going to look at, what's an exponential distribution? I don't even remember that. Log normal. Bernoulli, oh, no idea. This gives you a sense of how to pick a distribution. Yeah. You can if you have past data. So if you have something like interest rates or oil prices, you can actually fit it to the past. But if you're doing revenue growth, it's much more difficult, right? Then you might give it revenue growth across companies. But there are two ways you can give it data: historical data in some cases, cross-sectional data in others, and Crystal Ball can fit the distribution for you. So you're right, it does come with that added feature. It's an Oracle product. It's a, you can actually download a free version if you don't want to do the NYU version for yourself. The free version obviously stamps across your output, crystal ball output, so you can't really get, but for yourself, it still works. But it's a great add-on to your toolkit. Now, doesn't make your valuations better, but lets you face up to uncertainty. Any questions on simulations? So now let's start on the pricing switch. In intrinsic valuation, the value of an asset is a function of its cash flows, growth, and risk, right? I've said this 100 times. I'm going to repeat that again. And the tool we use to estimate intrinsic value is a discounted cash flow model. But don't let the D, the C, the F stand in the way of what you're trying to do. You're trying to take a business model, convert it to revenues, earnings, cash flows, and then risk adjust those cash flows. That's what we do in valuation. In pricing, what you're trying to do is look at what other people are paying for similar assets. What's price driven by? Demand and supply. You're saying, aren't demand and supply driven by cash flows, growth, and risk? Maybe. But they're also driven by mood and momentum and revenge and all those human forces. Value process yields a value, the pricing process yields a price. And people use the words interchangeably. Right? Value, price, they often, when they say I'm valuing something and using a PE ratio, they're really pricing things. I know I'm a bit obsessive about drawing the contrast between those two words, but let's talk about the gap between value and price. Now, you've got a value process delivering a value. There's a pricing process delivering a price. Will the two be equal? There's one version of the universe where the two will be equal. And that's if you believe that markets are efficient. Gene Farmer won the Nobel Prize for essentially, Gene talks about price and value being interchangeable. He's on firm ground because in his world, the two are interchangeable. But for most of us, the two can yield different numbers. And I'm going to give you two extreme versions of how people think about the gap. The first version you're going to run into if you go to Omaha at a certain time of the year to visit a certain company's annual meeting. You know what I'm talking about, right? You're valuing Berkshire Hathaway. Every year, people journey out to Omaha. They're true value investors. I'm going to call them value extremists. And here's what I mean by that. They believe they own the high ground. They estimate value. The market is shallow and stupid and does crazy things. And the price will always adjust to value. So if you're a value extremist, you think your value is the right one. The price has to adjust. The other extreme is what I call the pricing extremist. When I show up on CNBC, the show I enjoy being on the most is when the market closes, after the close of the market, because it's me and four traders, right? And they're completely open about their contempt for value. So what are you wasting your time on this intrinsic value stuff? There's no such thing. If you're a pricing extremist, you say there's no such thing as intrinsic value. It's all about demand and supply and mood and momentum. So when you think about the gap, in a sense, you also have to take a position on the gap. And many of you will be required to do that when you have to make a decision on your valuation. So let's think about it. Let's suppose you're a believer in intrinsic value. You find a gap between the value and the price, as you have in your intrinsic valuation. Before you get too confident, there are two things you're uncertain about. And you tell me whether you agree with this. First, you're probably uncertain about your value, right? You came up with a value, you could be wrong. So you're uncertain about that gap itself because your value could be higher or lower. So you're uncertain about the gap. You're also uncertain, even if there's a gap, as to how the price will move to close the gap. There are two things you're uncertain about, whether you got the value right or whether the price will adjust to the value. This is my biggest argument against concentrating portfolios. In a concentrated portfolio, what do? You pick one company or three companies that you think are significantly undervalued. You put all your money on them. To me, that's arrogance, because you're saying not only are you feeling comfortable about the valuation of these companies, you're convinced that the price will adjust value. I don't know what world you live in, but in the world I live in, I don't feel that confident about either number. I diversify. I hold 30. I mean, yesterday I counted the number of stocks in my portfolio. I have 42. I have 42 stocks because I'm not that certain about the values I've estimated. I'm not certain the price will adjust to value. I need the law of large numbers working in my favor. So I'm not going to call Mark Cuban wrong for saying he owns a concentrated portfolio, but I'm going to call him wrong anyway. Because if I put my money in 5 stocks, I'm assuming that these uncertainties have become small enough that I don't care. So the question is, how does this gap close? So did you find the stock to be undervalued with Berkshire Hathaway or overvalued? Undervalued, okay? So let's say you buy the stock. What are you hoping will happen? The price will adjust to value, right? There are 2 ways this can happen. One is what I call the karmic view, which is, I don't control that. I'm going to buy this and hope and pray, and sometime it'll happen. That's why I called investing faith, right? You invest and you have faith, but faith doesn't always deliver. The other is you can look for catalysts that'll cause the two to converge. I'll give you the more explicit example of being a catalyst. When a Carl Icahn or a Bill Ackman buys an undervalued stock, they don't buy and hold and let karma work it out. What do? They're incredibly noisy about what they've bought, right? They're on CNBC, they're telling, doing, interviews. Essentially, what are they hoping to do? They're hoping to be their own catalyst. So can you be the next Carl Icahn? How many billions are you planning to invest in Berkshire Hathaway? If it's 3 billion, you can be, but if you're 3,000 or 30,000, you're not going to be the catalyst. Nobody cares. So I'll give you a second tactic you could look for. You want to find an undervalued company where something will happen where the market notices the undervaluation. You know what? If I have 2 companies that are equally undervalued, and one has a 35-year-old CEO, and the other is an 81-year-old CEO, I'm going to go with the company with the 81-year-old CEO. Morbid thought, but 81-year-olds have a very real risk of not making it. You're saying, what does that mean? When companies often get relooked at is when a new management team comes in. I don't know what the capital IQ is, the age of the CEO in there, but one of your screens might be, I want undervalued companies with CEOs above the age of 75. And then you hold those companies and you look at the obituaries. There's my trigger, right? I know it's a morbid thought, but you want the market taking another look at your company. So you can buy, hold, and take the karmic view, or you can try to add something to the mix. The case of Berkshire Hathaway, there is a very real trigger point. I don't know which direction the price will adjust, though. And I will leave it at that and let you fill in the gaps, because there were 2 people last year. There'll be one person this year. I don't know how many people there will be next year, but it's something to think about with the company. So I'm going to close off this discussion with why I pick the same companies to value over. So people often ask me, why do you keep valuing Apple and Amazon and Facebook over and over again? So I'll start with that question, though. Something that draws attention to them, right? So, well, I think part of it is if there's something working in the law. Tesla, for instance, there is going to be an FSD announcement sooner rather than later. It's not. So the question is, how much will that trigger? With Tesla, there are constant catalysts cutting in both directions. That's why with the Tesla is undervalued, the correction happens much more quickly because of the nature of the company. So sometimes it's what the company does. There are some companies with the catalysts are few and far between. Coca-Cola, what's the catalyst? Now, it's very difficult to find one. But with a software company, the catalyst might be an AI software they come up with. So you're looking for rumors, you're getting ahead of the game, you're saying, I hope that pays off for me. Right? So it's not easy to identify what that is, but you will know it when you see it. Okay? Now, the reason I revisit my company valuations over and over again is you put in a lot of work to do your first discounted cash flow valuation, right? I don't know how many days you spent on it, but it's hours, perhaps days. You know, the second time you value this company, let's say you revalue it next year, it's going to be a lot less work because you've done the bulk of the work telling the story. Things can change. So I find it useful to revisit my valuations because it's not that much work updating it. You see, but what's the point? If you found it overvalued in 2012, why do you keep visiting it? What are the two numbers that determine whether a stock is undervalued or overvalued? One is my estimate of value. The other is market price. In the case of Apple, for the last 15 years, I've told pretty much the same story, which is it's a slow growth cash machine. Why slow growth? Because the bulk of its revenues now come from the smartphone, the iPhone. The smartphone market has matured as a market. There's no way you're going to grow 15% a year in that market anymore. Where's the growth going to come from? So I've treated it as a slow growth company, but it's a cash machine. It makes incredible margins in the iPhone, delivers hundreds of billions of dollars of free cash flow. So my value has reflected pretty much the same story. There are quirks in the story that can cause the value to go up and down. You can see my value has gone up because they've had good things happen at the iPhone with each upgrade. But the price per share is all over the place, and here's why. Now, I view Apple as a company that goes from upgrade to upgrade. That's their catalyst. A new iPhone comes out, the entire world comes to a stop with Apple, right? Will that upgrade sell well or not? You actually get tweets from Shanghai saying there's nobody outside the Shanghai Apple store, sell Apple. Yeah? But you do these little things to kind of build. And when an upgrade does really well, people think Apple's back to being a double-digit growth company. Completely unrealistic, but that's the way markets are. If Apple has a bad upgrade, they say this is the end for Apple. And Apple, so the price goes up and down. And what drives your investing? What the price is relative to the value. I've bought Apple 4 times in the last 15 years. I've sold Apple 3 times. So this is like Amazon, a stock that goes in and out of my portfolio. Because I've never understood this notion of you buy something and forget it for the rest of your life. Because it goes against the notion of value investing. So I'm going to close the intrinsic value section with one of my favorite movie clips. How many of you watched The Wizard of Oz, the original version? Incredibly long movie, right? Like 3 hours. Those were the days when you got full value for your movie. Now you go to a movie, hour and 7 minutes in, the movie's done. You say, what? I paid $20 for an hour and 7 minute movie? If you've never watched The Wizard of Oz, let me give you my compressed version of the movie. And if I'm abusing the movie, it is what it is. Here's how the movie begins. It begins with a tornado touching down on Kansas. And that tornado sucks up this little girl called Dorothy. You think that is so unrealistic. Hey, I didn't write the script, somebody else did. So the girl gets sucked up. So Dorothy gets sucked up by the tornado. The tornado dumps Dorothy into Oz. You're saying, where is Oz? It's the 51st state in the Union. And she lands on top of a witch. And I'm always, I always have trouble with which way. It's a wicked witch of the east or the west. She lands on the witch. She kills the witch. She faces homicide charges. And she wants to get back to Kansas. So this happens the first 10 minutes of the movie. So if you're taking a kid, skip the first 10 minutes. It's very, very, very traumatic. Because then Dorothy says, I want to go back to Kansas. And she sees this little munchkin standing on the side of the road. And she says, how do I get back to Kansas? That munchkin has never heard of Kansas. He says, you got to go talk to the Wizard of Oz. He knows everything. And she says, obviously, how do I get to the Wizard of Oz? She says, follow the yellow brick road. And for the next 3 hours, that's what you see, Dorothy hopping and skipping. She never walks in the movie. She hops and she skips down the yellow brick road. And along the way, she accumulates this motley crew. A cowardly lion, a tin man, a scarecrow. They're all wanting something, and they're all told, go see the Wizard of Oz. He has the answer to everything. So 3 hours later, they land up in the Wizard of Oz's office, so to speak. You can't see him because he's behind a curtain. He says, why are you here? And each of them says, Dorothy says, I want to go back to Kansas. The cowardly lion says, I want courage. And the wizard says, come back tomorrow. It's like a government office, right? So we've gone 3 hours in this movie to get here. We can't come back tomorrow. And at this point, the curtain falls and you realize there's no wizard. This is a terrible ending to a movie, right? But it turns out that each of them got what they wanted on the journey. Remember what Dorothy got that allowed her to get back to Kansas? those red shoes, right? You click the shoes, she's back in Kansas. The Cowardly Lion fought off some bad guys on the journey, got courage, each of them. You say, what's this got to do with valuation? I mean, I know many of you in your valuation are focused on the end number. What did I get as a value per share? The destination. You learn valuation in the process. As you think about revenue growth, you might think, this is such a waste of time. I want to see what the value per share is. You learn valuation in the process. And if you ever have a question, the answer is in the process. So when you say, what tax rate should I use to estimate cash flows? Don't go do a Google search. Don't email me the question. During the class, obviously you can. You already have the ammunition to figure out your answer to that question. There are no unanswered questions in valuation. There are questions you can try to answer. You might not get the right answer, but trust the process. Remember what you're trying to do, because that's always going to give you the answers. How should I do this? Okay. So that's going to be my last slide on intrinsic valuation. So let me close that up and go on to the third packet. I'm sorry, today we have 3 different packets. So let's talk about pricing. Sorry, I have to blow my nose. It's going to sound disgusting, so I'm going to turn off. I once made the mistake of not turning my mic off and going to the restroom. Never again. Right? Okay, so let's talk about pricing. The essence of pricing is you try to attach a number to something based on what other people are paying for similar things, right? So I'm going to the Yankee opening day on Friday. I'm just hoping and praying that it stops raining. Okay? I had to buy the tickets. I went on, I think, StubHub. I might have gone on SeatGeek, but I get tired of the additional charges after you look at it. That's a cheap ticket. By the time you're done, it's twice the price. And I wanted, a particular section. So you know how I decided how much I was willing to pay, right? I looked at other tickets in that section, and SeatGeek helps you out. If you've ever been on SeatGeek, they classify deals into amazing deals, great deals, good deals, and fair deals. They never say poor deal, which makes me a little suspicious. There must be poor deals there. You're saying, how the heck do they do it? Very simply, they take all the tickets in a section, they look at the price people are asking and compare it to the average price in each section. They're doing pricing. And already you can see what you need for pricing. To price a stock, you first need to find other companies just like your company. It's called a peer group. Is that a subjective judgment, though? If you're trying to price a software company, is there a subjective component to coming up with that peer group? What do you think, Sebastian? Yeah, you could say, I want to look at only US software companies, big software companies, entertainment software companies. Already you can see that if you thought doing pricing meant that you didn't have to make subjective judgments, think again. Start with the peer group. So you come up with 25 companies, you get the price per share. You're very quickly going to recognize that you can't compare price per share across stocks. Why? Because the per share number is completely arbitrary. What's Berkshire Hathaway's Class A stock trading at right now? Yeah. It's like 6 digits in its price, right? If I just looked at price per share, Berkshire Hathaway is incredibly expensive and penny stocks are cheap, but that's silly because price by itself, I can have the price of a stock by doing a 2-for-1 stock split. So you know what we do with stock prices? We scale them to something. Sounds mysterious. I divide price by earnings, price by book value. So basically a multiple is just a standardized price. So I come up with a peer group. I have the standardized price. I compare my stock to that group. And then I tell a story about why my company should trade at a higher multiple because of higher growth or a lower multiple because it has higher risk. Peer group, standardized price, story. If you get a chance, pick up a sell-side equity research report and you're going to see pricing at play. So I'm going to start by making a few assertions about pricing versus intrinsic valuation. I'll back them up. Much of what passes for valuation out there, you know what I mean by out there in your banking jobs, in your equity research jobs, much of what gets called valuation is really pricing. Let me back that up. About 25 years ago, I collected about 550 equity research reports from around the globe. I must confess, I didn't read all of them. I collected them because I wanted to classify how equity research analysts put a number on a company and came up with a recommendation. 85% of sell-side equity research is based on pricing. There's a multiple, there's comparables, there's a story. There was an obligatory discounted cash flow model in many of them, but you could see their hearts were not in it. It's there because it was supposed to be there. Much of equity research is pricing, and that doesn't surprise me. Because as an equity research analyst, you're given a sector, and what's your job? Tell me what's cheap or expensive within those 20 companies that you track. But I said, maybe it's different in banking. So I've got my hands on 100 acquisition valuations. You know how difficult it is to get these? Because once banks do this, they put it in deep storage because they never want you to compare their projected numbers to what the actual numbers are, right? But I have my sources, and I was able to get 100 acquisition valuation. At first sight, it looked more like a 50-50 split. But then I took a deeper look at those discounted cash flow valuations, and I realized they were pricing in drag. You know what I mean by that, right? What's the biggest number in a DCF? Of all the cash flows, which is the biggest now? Terminal value. And we talked about this. In most of these valuations, that terminal value was a multiple, an EV to EBITDA, an EV to sales, a price earnings, which means it was already a forward pricing. The world is a pricing world. Get used to it. Because it'll remove a lot of the frustration you might feel when you get out there and say, why isn't anybody trusting my DCF? Because they live in a pricing world, and this is not the tool you would use there. So when you look at much of what happens out there, you see that it's almost always pricing. And I've always struggled with this, and here's why. You know, whether you remember at the start of this class, I asked you a question. And at that time, you really didn't have the ammunition to answer the question. The question was, given what you know about these approaches, do you trust an intrinsic valuation of pricing or neither? At that time, I said, who knows? At the end of this class, I'm going to ask you the same question after you've had a chance to do an intrinsic valuation and a pricing of your stock. And here's what those numbers look like when I ask people as they leave this class. 70% of the people who leave this class, when I ask them intrinsic valuation or pricing, pick intrinsic valuation, perhaps to keep me happy. That's my instinct. 20% pick pricing, because after they've tried a multiple, they say, this is so much better. No revenue growth, margin, sales to capital. I'll just pick PE ratios. And about 10% become believers in efficient markets after they valued one company. You know why? Because you realize how difficult it is to put up, because until you could have walked into this, this is easy. Why is the market screwing up in NVIDIA? Then you try and say, I see why it's screwing up. There's so many things that are out of my control. That's a completely healthy place to be, because if you're in that 10%, what should you do with the rest of your lives? Never value another company again. Go back to living your life. You can have a perfectly happy life without doing a DCF model. Unless that happens to be a job. Do it if it's your job, get paid for it, but go put your money in an index fund and move on. 70, 20, 10 when they leave my class. I haven't done a follow-up interview 5 or 10 years later when they're at their jobs. And at last count, I have about 25,000 students who've gone through my classes. If I track them down, 5 years after and say, when you left my class, you told me you're a true believer in intrinsic valuation. What are you doing at your desk right now? My guess is the numbers get flipped. That the 70% who believe in intrinsic valuation have become pricing people, and maybe 20% hold on to intrinsic valuation, but they've been fired. Okay? But there's something that happens between the time people leave this class and they go to work, where they go from being true believers in intrinsic valuation to users of pricing. So I wondered why that is. And I've come up with 3 possible answers, and I'm welcome to listen to more. The first came to me while I was watching a Seinfeld episode. If you haven't watched Seinfeld, this will make no sense to you. Those of you who watch Seinfeld, this is the quintessential New York sitcom. And this is an episode, one of Jerry's many girlfriends accuses him of being crazy. She says, Jerry, you're crazy. He says, if you think I'm crazy, you should see the guy who lives across the hall from me. You know who lives across the hall from Jerry? A guy called Kramer. And relative to Kramer, who's crazy, right? You think, what's this got to do with valuation? We forget how much of valuation is selling. It's easier to sell a pricing than a valuation. You're trying to sell me a company that's trading at 10 times revenues. Show me it's cheap. What do? You find 3 other companies that trade at 30 times revenues. Look, it's cheap. I might have used this line before, but I'll use it again. You have cholesterol of 300. Not too bad. Say, what do you mean not too bad? Relative to people who've died of heart attacks in the last week, you don't look too bad. I picked the peer group. I can basically show you that something is cheap or expensive as long as I control the storytelling. It's easier to sell a pricing than a discounted cash flow valuation. It's also easier to defend a pricing than a discounted cash flow valuation. You send me your DCFs, right? I could pick them apart. Why is your revenue growth 17%? Why couldn't it be 19? Why is your cost of capital 10.23%? Why isn't every number is out there for people to pick apart? It's infuriating. If instead you told me that your stock is priced at 6 times EBITDA because that's what other companies in the sector are priced at, think of how small my target is. You don't like 6 times EBITDA? Take it up with the market. That's basically what you're saying in pricing. It's not my fault. I'm just the messenger here. It's much easier to defend a pricing. You go to a road show for IPOs, you will never see a DCF mentioned. Everything will be justified based on a pricing. And finally, I'm a believer in intrinsic valuation, but I'm also a realist. I do believe that you're more likely to be right with intrinsic valuation than pricing, but not 100%. You're going to be right 55% of the time with intrinsic valuation, 51% with pricing. 55 beats 51, right? But here's the catch. When you're wrong with an intrinsic valuation, you're far more likely to be wrong alone. Why is that? Why does intrinsic valuation lead you to be more likely to be wrong alone? What are the, no, some of you are valuing NVIDIA. You value NVIDIA and you're doing an intrinsic valuation. I haven't pre-looked at numbers, but I'll wager that 10 people are valuing NVIDIA, 8, 9, or maybe 10 are going to find it overvalued. Why? Because you're looking at it after the price is soared. You're going to be selling things that everybody else is buying or buying things that everybody else is selling. The nature of intrinsic valuation is you're going to be a contrarian. That's good, right? But you know what happens to people who are wrong alone on Wall Street or in any aspect of business? What happens to them? They get fired. In contrast, if you use a pricing, you'll always have lots of company. So if you bought NVIDIA now at 875, peak price, and it drops to 600, I'll wager there are portfolio managers out there loading up on NVIDIA way too late. But if the price drops, none of them are going to lose their jobs. And their justification is, don't blame us. Everybody else was doing it. People are more likely to go with pricing for survival reasons. You're more likely to survive as a portfolio manager or sell-side equity research analyst if you price things rather than value them. And it's changed the way I teach this class. When I first started teaching this class, I used to convince people that intrinsic valuation was the better way to go. I no longer do that because many of you will end up in jobs where you have to price things. So increasingly, this class is not about why you should do intrinsic valuation, but how to do pricing better. Because pricing is an essential ingredient, a tool that you need in much of what you see out there in jobs that are called valuation jobs that are really pricing jobs. So I'm going to give you my rationale for why once I'm done with an intrinsic valuation of a company, I still price it. So I do an intrinsic valuation of a company, whether it's Peloton or whether it's Birkenstock or whether it's, whatever company. I'm not going to stop there. Nothing stops me from pricing the stock as well. Because if I find something to be both undervalued and underpriced, I have two things working in my favor, right? I need a correction. And it doesn't matter whether the traders cause the correction by causing the price to go up or whether the market causes the correction by price going to value. Nothing stops you from doing both. Why do we act like it's an either or? You see people argue, I'm an intrinsic value believer. I never price stocks. Why not? Why not do both? You can still trust your intrinsic valuation as your base. So pricing is you can still price things. And if your job is relative, you're judged against the market, against other portfolio managers, you have no choice but to price things. So let's talk about pricing done right. And to start this process, I'm going to actually deconstruct that second step that I talked about in pricing, which is to come up with this standardized price, a multiple. Let's look at what goes into multiple. In the numerator, you always have a market number. That market number can be the market value of equity. In Yahoo Finance, what's the item you're looking for market value of equity? Or the market capitalization, market share price times number of shares. The numerator can have market value of equity plus market value of debt, though people cheat and use book debt. Why? Because it's tougher to get market debt. It's called market value of the firm. Or you can take market value of equity plus market value of debt minus cash. It's called enterprise value. They're market numbers that goes in the numerator. But I scale those numbers to something, and here are the choices. I can scale the market value to revenues. Why would I scale it to revenues? Because I'm desperate. I'm in a sector where everything is negative. The only positive number I have is revenues. I'm going to scale it to revenues. What if you have pre-revenue companies? Then you're in real trouble, right? Then you scale to things that might cause you revenues. Users, subscribers, number of cars in the parking lot. You need a positive number in the denominator. You're either going to use actual revenues, something that might cause revenues. So that's the first scale. You can scale it to earnings. Those earnings can be to equity investors, net income, earnings per share, or it can be the entire firm, operating income. You can scale it to cash flow. With equity, that cash flow can be net income plus depreciation, kind of a half-assed equity cash flow. Or if you're a firm believer in doing this right, a free cash flow to equity. It can be to the firm, where you take EBIT and add back depreciation, amortization, the much used EBITDA, or you can compute an actual free cash flow to the firm. So revenues, earnings, cash flow, or you can scale to book value. What is book value measure? It's what the accountant tells you your company's worth, right? It can be book value of equity, or book value of the firm, book value of equity plus debt, or book value of debt plus equity minus cash. Does that look mildly familiar? Have we used that somewhere? It's invested capital. In the denominator, return on invested capital, this is what goes into our return on invested capital, that invested capital. So you take the market value and you scale it to something. Okay. So I'm going to give you a 4-step process for becoming a better pricer, because many of you are going to have pricing jobs. And I promise you, if you're religious about following these 4 steps, you will do pricing better. The first step is I'm going to take your multiple apart and pass it through 2 tests. Is it consistently defined? And I'll talk about what I mean by consistently defined. And is it uniformly estimated? For the moment, just leave them floating out there. That's going to be my first step, to make sure you're not using a biased multiple. Second stop, I'm going to describe the multiple. Sounds fancy, but I'm going to play some Moneyball. You guys watch Moneyball? The movie? Great movie. You should watch it. Yeah. Play the Jonah Hill character, right? When he asked, should I sign, Kevin Youkilis? His answer was, the scouts don't like him. He has a terrible batting stance. I still remember watching the first time. How the heck does this guy ever hit a baseball? But he was the Greek god of walks. He had this great eye, and he managed to get on first base more often than any other minor leaguer at that time. And Jonah Hill said, the scouts might not like it, but whether you get to first base with a base hit or walking, you get to first base anyway. He let the numbers drive it. So second step, I'm just going to give you the numbers. What does that mean? And he asked me, what's a high PE ratio? Why would I make up a number? I'm going to give you the entire distribution. You can decide for yourself. So define, describe. The third step, I'm going to take the multiple apart. And for the moment, trust me on this one, I'm going to go back to a DCF model. And with each multiple, I'm going to tell you, these are the variables that drive this multiple. And only then am I going to apply the multiple. Define, describe, analyze, apply. I'll tell you my problem with pricing is not that people do it, but that they do it badly. They're sloppy. They act like it's 1965, but the data is not there. We have the data. We might as well do this right. So let's start with the first of these tests. Is it consistently defined? Is it uniformly estimated? Start with a consistent definition. Remember I said a multiple is a numerator and a denominator? Here's the rule. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator also has to be a firm or an enterprise value. I know it's cruel and unusual punishment to hit you with this late in the day, but I'm going to throw a few multiples at you, and you tell me whether they're consistently defined. Let's start with PE ratios. What's in the numerator? Equity value, firm value, enterprise value. What equity value, everybody agree with that? Price per share, market cap, so numerator. What's in the denominator? Earnings per share, right? Equity value, firm value, or enterprise value? Equity value. Thank God for small blessings. The most widely used multiple in the world is okay. Let's move on to EV to EBITDA. What's in the numerator? Market value of the operating assets of the company, right? What's in the denominator? A rough measure of operating cash flow. EV to EBITDA is okay. What about price to EBITDA? The analyst who invented this multiple should be tarred, feathered, and driven out of the fraternity if there was one. Out of the 550 equity research reports, 9 used price to EBITDA. And one of them happened to be an old student from this class. So I decided to call him. I called him and said, look, I've been reading your equity research reports. I notice you're very fond of price to EBITDA. You do realize it's not consistent, right? His answer was, no, I'm being consistent. I said, what do you mean you're being consistent? He said, I use price to EBITDA for all 15 companies in my sector. I said, really? I said, have you been noticing that companies with a lot of debt keep looking cheap to you? He said, yes, I've been noticing that. I said, have you ever stopped and asked why that might be happening? Do you see why using price to EBITDA is going to make companies with a lot of debt look cheap? Let's say I'm a company, I borrow money and I buy back shares. I reduce my equity, right? But my EBITDA is before interest payments, taxes. So basically it's before debt. The more highly levered a company, the cheaper it's going to look on a price to EBITDA basis. Before you feel too superior. You know, that 15% of sell-side equity research technology companies uses price to sales ratios. It's exactly the same problem. You can't divide market cap by revenues because revenues don't belong to equity investors. See, how do they get away with it? You know what lets them get away with it? How much debt do most technology companies have? Not much. It's purely accidental that you were able to get away with it. But people are inconsistent all the time. Second stop, is it uniformly estimated? Why does that matter? What are we using these PE ratios to do? Compute them for 15 companies and compare them across the 15, right? If they're not estimated the same way for all 15 companies, I'm talking about the earnings per share, I'm going to get very different judgments. So I'll give you an example. Let's suppose you have 2 different accounting standards and 7 of the companies use one and the other 8 use a different one. I can't compare their earnings per share because they're coming from very different accounting standards. Is it consistently defined? Is it uniformly estimated? So let's try this out on a few multiples. It'll look like I'm crying at the end of this class, but it's, you know, the allergy kicking in. I'm actually probably a disgusting mess. My nose is running, my eyes are running. No. Ignore my face. I'll cover my face if you need. Yeah. So let's take a few multiples. Let's see if they pass the test. Let's start with PE ratios. I already told you they're kind of consistent, right? Numerator equity value, denominator is an equity value. Everybody kind of understands what the PE ratio is, right? Even Anna Kournikova seemed to know what the PE ratio was. You guys have never heard of Anna Kournikova, right? She masqueraded as a tennis player for like a decade, won nothing, but ended up on a lot of commercials. This is an actual commercial that Charles Schwab ran. I was a Schwab customer. I almost canceled my account right after the ad ran. And in the ad, Anna Kournikova is playing somebody. She must have been an actress. She was actually winning. So the middle of the tennis match, you know, every 2 games you switch in tennis, they're switching. In the middle of a tennis match, I don't know why this would come up. Anna Kournikova says, price earnings ratio is price divided by earnings per share. And then she went on to say something about preferred dividends that went right over my head. So I turned off the TV and started thinking, does Anna Kournikova really know what the PE ratio is? Let's break it down. Numerator is usually the current price. Unless you have a technical analyst gone crazy who likes to use moving average prices. If anybody does that on you, ask them a question. Have you ever tried to buy a stock at a moving average price? It doesn't work for me. So it should be the current price. But it's in the denominator that you get the real action. I could divide by earnings per share in the most recent fiscal year. That's called current PE. I could divide by price by earnings per share in the last 12 months. That's called trailing PE. I could divide price by expected earnings per share in the next 4 quarters. That's forward PE. Or I could divide price per share by expected earnings per share in 2033. That's really, really forward PE. Why would I do that? Desperation again. Every company in my sector is losing money. The only tool I have is PE ratios. I project earnings out 10 years. I could estimate earnings per share before extraordinary items and after extraordinary items. I could estimate earnings per share before lease. So basically, I remember about 10 years ago taking a company, the company I picked was Cisco, one of the most widely followed companies in the market. And I computed 35 different PE ratios of the company at one point in time, depending on how I estimated earnings per share. I came up with estimates of the PE ratio from 14 to 35. You think, so what? Remember we talked about bias in the first class? Let's say you're trying to convince me Cisco is cheap. Which of those PE ratios are you going to latch on to? The 14. And if you want to convince me, no, when you see equity research analysts start to argue on CNBC, one is bullish, the other is bearish. Look at what they use to make their case. Bullish analysts always use forward earnings because it gives them a lower value. Bearish analysts always look at trailing earnings. They're talking about the same company, but using very different metrics. Let's build on PE ratios. The way PE ratios are computed, you take the price per share and divide by earnings per share. The price per share is a market number. You can't change that. But the earnings per share is a number usually computed. By doing what? By taking the net income and dividing by the number of shares. Let's say you're the tech analyst and that some of your companies in your sector have a lot of options outstanding and some have none. So I have a question which is just about bias and being fair. I'm trying to compute a PE ratio. With each one, I'd like you to tell me what kind of bias I'm going to have. If I divide price by the actual shares, the net income by the actual shares outstanding, I get what's called a primary earnings per share. If I compute price to primary earnings per share, what kinds of companies are going to look cheap to me even though they're not? Companies with a lot of options or companies without options? You got a 50-50 shot. What do you think? What happens if you have a lot of options? You're an investor in the company, so when you look at the company, it has a lot of options. What do you do to the price per share? You reduce the price per share, saying, so if I use the price per share and I divide by primary earnings per share, companies with a lot of options are going to look, in my case, cheap, not because they're cheap, but because I haven't counted it. If I divide by all shares outstanding, that kind of takes care of some of that problem, but I create a different problem. Why? Because not all options are equally made. Some are in the money, some are out of the money, and I'm treating them all as the same. Every single one of these approaches, you're going to run into a problem one way or the other. Here's my advice for you. If you're going to compute a PE ratio, rather than take price per share and divide by earnings per share, take market cap and divide by net income. You'll evade all of these questions. It's a much cleaner way of doing things. Let's move on to EV to EBITDA. Numerator is market value of equity plus debt minus cash. Denominator is EBITDA. I have a question that I ask analysts who use EV to EBITDA all the time. I ask them this question. Most of them are not able to give me the right answer, but I think you can. Here's my question. Why do we net cash out of the numerator? Why do we use net debt instead of gross debt when we compute EV to EBITDA? Anybody want to give that a try? Why do we use net debt? Why do you think it is? So should I take all liquid assets out then? Why just cash? If liquidity were the issue, then I should be netting out all liquid assets, and we don't. I'll give you a clue. It's got something to do with consistency. Look in the denominator, and you'll see why we net cash out. And why does that play out? How does it play out here? The income from a financial asset, where does it show up in the income statement?
In interest.
Which shows up as below the operating income line. EBITDA is above. The interest income from cash is not part of my EBITDA. That's why we need to net it out. It's a consistency reason. And I've opened a Pandora's box. So cash should be netted out because the income from cash is not part of my EBITDA. In the context of discounted cash flow valuation, what was the big other asset group whose income doesn't show up as part of my operating income? Think of the loose end valuation. Right after cash, what did we talk about? Cross holdings in other companies, right? If you have 10%, 15%, 20% of other companies, those are investments that are in your market cap. They're valuable, but they won't show up in your EBITDA because they're minority holdings. Conversely, if you have a majority holding, it creates a different kind of mess altogether, right? Because your market cap reflects the 60% you own, but every other input into this calculation reflects consolidation, which is 100%. What I'm trying to say is if you are running away from discounted cash flow valuation because you didn't like to deal with cross holdings, and I don't blame you, they're going to chase you down when you do pricing because they're going to affect how you compute these multiples. We'll do one final example and then we'll end for the day because I can't take my nose running anymore. One of the things that people use to judge housing, whether it's overpriced or underpriced, is they compute a ratio of housing prices to what you can make as net rental income from the house. So let's say you pay $1 million for a house and you can make a rental income of 50,000 a year. $1 million divided by 50,000 gives me 20 as my multiple. Why do they do it? Because they want to decide whether they should invest in housing or equity or bonds. They're trying to compute ratios you can compare. So let's say you've done that for housing. You've taken the housing price and divided by net rental income. And you're trying to find the analogous variable with the equity market that you want to compare it to. Here are the four choices: price earnings ratios, EV to sales, EV to EBITDA, or EV to EBIT. Which of those four would you compare your housing price to rental income ratio to make a judgment? First, let's look at the numerator. You have the housing price, right? Is that closer to enterprise value or equity value? It's closer to, is it? When you buy a house, do you usually buy it with all equity? It's closer to enterprise value, the housing price. It's not the equity portion of the value, so it's enterprise value. Net rental income is probably closest to EBIT, right? It's before depreciation. So if you want to get a judgment on is the housing market cheap or expensive, you want to probably compare to the EV to EBIT multiple, the stocks. And then you can decide 20 times rental income is too high or low. So when we start off next class, we're going to start with the second step. Once you've defined it, let's talk about describing it, analyzing it, and applying it. But I'm sorry about my nose running, nothing I could do about it.
So I had an issue with my model.
Thank you.
I had an issue with my model. I had a bunch of value errors. I tried doing what you recommended, so going in the option page. And I did, yeah. I put it in my email. I said I have value errors. I tried doing everything you asked me to do, and it didn't work. What did I say? You go to the options tab, and so you didn't reply to my email, but you have it on the template. So go in the options tab.
I'll take a look at it.
Okay, but it's fine. I'm just like wondering. I just wanted to let you know that it's going to give a bunch of value.
I'll take a look at it.
Okay, thank you so much.
What's your name? Because I sent back those quizzes. But not in the email. What's your name? What's your name? Send me an email. I could not email that.
So I'm figuring out Spotify access again. So I looked at yours and I was trying to figure out how you look at R&D. It says
It's not R&D.
but it doesn't say content. Just
It might be something to spend.
Oh, I haven't done I need a 90. Oh, I'm 35%.
You want to find that in the market?
No, no, but, so I guess my question was, in the footnotes, it just says like, development costs are capitalized once you know there's a.
That's always the case. That's in the